The lesson here, as Jeff alluded to, is he tends to think interest rates are never going lower than they presently are when history has shown us otherwise.
Well, in fairness, they haven't ever gone lower than they presently are.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old-fashioned real estate advice.
Welcome back to another episode of the Old Fashioned Real Estate Show. This is Jeffrey Holst. I'm
Brian Leverage.
That's right.
Hey, how about that? I got it right. You know, I get that wrong every once in a while. No, I really don't.
You're not the only one.
Yeah, well, that's probably true.
Yeah.
But that seems like a personal problem. On that note, we have an interesting topic to talk about today, and that is what you should be thinking about when borrowing money for real estate investments. In other words, what loan terms matter and how you should be thinking about them.
Sounds like a lot to unpack.
There's a lot here, but I'll tell you, this is one of the things that can make, from a personal side note, if you make the wrong financing decision, and we did a whole episode about why you should be using financing, and that'll be, right above our heads like we do, but if you make the wrong financing decision, like you get too high of an interest rate or too large of a prepayment penalty or the wrong kind of rate structure, it can cost you big time in real estate investing. So it's really important that you think about the following things. So the first thing you're going to want to think about is, what's the rate? That's actually really important. But most people stop there. I hear all the time, and we're dealing with this on another project right now, people go, well, I want to know the rate, but they forget about things like PMI, right? They forget about things like prepayment penalties, adjustable rates versus fixed rates. So when you're thinking about rates, Brian, what's the general rule of thumb that what's the first thing you're worried about?
Well, you of course want the lowest you can get for yourself, not to be Captain Obvious. But at the same time, you also are looking for the most stable, low-risk loan product in conjunction with that, right? Like there's other costs. You already alluded to those.
So lowest rate is one element, right?
Yeah.
The next element would be like, is it fixed versus adjustable? Because you could get an adjustable rate mortgage. This is what happened in the loan crisis in 2008 and 9, is there were a lot of people with adjustable rate mortgages, and then the balloons came due. A balloon payment meaning you have to pay the whole thing off.
Or not even just that, the rate just recast,
adjusted,
and on a 1 year negative amortization where you're not even paying all the interest in a given month, so your loan balance is actually increasing every month. And
or your payment goes way up.
Yeah.
And then and you can't refinance to get out of that increased rate because you don't have any equity.
But if we're speaking to an investor audience here, it's a little bit different,
sure,
right?
But you still can get adjustable rates.
Of course,
we do this all the time.
We do adjustables on just about everything we do.
Yeah, and now, in fairness, we try to get 3 or 5 year locks. So the first 3 or 5 years is locked on the rate.
Yes.
And I think it's really important when you're looking at an adjustable rate mortgage to make sure that you understand whether it balloons, as in you have to pay it off at the end of 3 or 5 years, or if it just re-amortizes over the remainder of the term at the new rate. Yeah. And then also how often the rate adjusts. The rates that we do, if we lock for 5 years, they adjust once every 5 years, but some rates will adjust every quarter, every month.
Or it could be 5 years and then every year after that.
Yeah, so you have to make sure you understand how those adjustments take. So that's one thing that you want to look at. Another thing you want to look at is prepayment penalties. Because if rates go down, you might want to refinance, or the value might go up and you might want to take some money out.
And to be clear, I think this is generally an issue when you're talking about larger loans on commercial or multifamily properties through agencies such as Fannie Mae and Freddie Mac, or insurance companies who are another big issue.
The larger the loan, the more likely it is.
And I would say the longer the maturity on a fixed rate debt, the higher the likelihood you're going to have a pretty onerous type of prepayment.
Yeah, and obviously so the thing is, banks are in the business of making money. So if you have a higher interest rate, you're more likely to have a lower non-existent prepayment. Now, if you're locking something in over a 30 or 35 year amortization at, some really 3%. Low rate, 3% or less, there's going to be a prepayment penalty on that because they want to know that their money is going to be invested for a long period of time. There are different ways that these prepayment penalties can materialize, and you have to understand them. I personally made this mistake before on our very first non-recourse product. My partner, not you, but my other partner, Travis, and I bought a 32-unit apartment complex with a Fannie Mae, non-recourse loan.
And you had what's called yield maintenance.
We did. We had yield maintenance, and we looked at it and said, oh, well, that's fine. But the problem is it's a 30-year amortization, 10-year term, so the loan has to be paid off at 10 years, but we got stuck with 9.5 years of yield maintenance.
Yeah.
Now, for people that don't understand yield maintenance, what yield maintenance is it's basically you're assuming the interest rate risk. So if the interest rate goes up during that 9.5 years, the bank can take the money if you pay them off and reinvest it at a higher rate, and you won't have any prepayment penalty.
Correct.
If, on the other hand, the rates go down and you pay them off, you have to pay the difference from what they can currently invest the money at and what they would have made if you had it invested. And in our case, 3 years ago when we bought that, we thought rates were pretty low. Rates have gone down a lot. Ergo, we have a really big prepayment
The lesson
penalty.
here, as Jeff alluded to, is he tends to think interest rates are never going lower than they presently are when history has shown us otherwise.
Well,
So-
in fairness, they haven't ever gone lower than they presently are. But so in fairness to Brian, he's absolutely correct about that. At that point, I thought rates weren't going down. But I will say the mistake that we made wasn't that we made a bad business decision. No. The mistake that we made was we didn't understand yield maintenance. And now a word from our sponsors. Who's sponsoring us today, Brian?
Well, we are, Jeff.
We are. How
Yes.
amazing. So we want to tell you about how you can save an enormous amount of money on your taxes and how Brian and I have been able to eliminate our taxes entirely.
You guys need to learn about cost segregation, which you can do by going to our website, oldfashionedtaxsavings.com.
Yes, and if you go there and you fill out the form, you can get a free, no-cost benefit analysis that will show you how much money you can save and what it will take to do that. So if you're looking at getting particularly a larger balance loan, $1 million or more, and there's going to be a prepayment penalty in, make sure you understand how that prepayment penalty is calculated.
Because it's not just yield maintenance.
Sure.
Some of them have sort of like almost a waterfall over time.
Yeah, they call it step-down
Yeah.
prepayments. You'll see this a lot. There might be only 5 years of prepayments. It might be if you want to pay it off in the first year, you pay a 5% of the outstanding loan balance. The next year 4, the next year 3, the next year 2, the next year 1, and then it's 0 after that. And that's okay, but that's still very expensive. If you had a $2 million loan with a 5% prepayment penalty, it's going to cost you $100,000 in extra interest to pay that loan off.
I think the point is that, before you undertake any type of that debt, you really need to understand what your purposes are in getting that debt in the first place. Yes, it absolutely helps your cash flow over the long run. You obviously get the amortization gains, etc. But, if you have to sell before you think you're going to sell, before the loan matures, really.
Sure, if the value goes up, or you have a partnership
or
issue.
you even want to refinance because rates go even lower, which, as we've seen, despite our thoughts to the contrary, and to be fair to Jeff, I've certainly looked at rates recently and been like, there's no way they're going to go lower. And yet, that's exactly what happened.
Yeah, I mean, listen, a year ago, if you had asked Brian or I, we would have said rates in the mid-3s are as low as it's
great,
going to go. Yeah. And by the way, you should lock in long-term debt right now. We're not suggesting not to. Just be aware of what the cost of doing that is. Because anytime you borrow money from a bank or from a private lender or from any kind of institution, there's a cost to that. And you have to understand the cost in order to make an intelligent decision. It's not all just about cash flow. I mean, obviously, if you had a loan that amortized over 100 years versus 10 years, you're going to pay a lot lower payment, but you're also going to potentially have much higher expenses over that. You're going to pay interest for 100 years.
I mean, for me personally, I'd make the argument that on smaller investment properties, 1 to 4 unit type stuff, that if you've got the money and you're not really relying on the income coming back from that one asset or even multiple assets at the same time, you're probably better off financing them on a 20-year amortization just because of the amortization gains you get from principal reduction in a 5-year hold time. Right?
Yeah, I mean,
compared to a 30-year loan where you're not overpaying.
Yeah, I mean, on a 30-year loan, you pay very little off in the first 3 or 4 years. I mean, everyone knows that. If you have a home mortgage and you pay your payment every month and you don't pay any extra, you're only going to pay off a few dollars a month in the beginning of the loan because there's such a long time for that extra pay down to accumulate. Now, on the flip side, if your strategy is to get the most amount of cash flow, you might want a 30 or longer term. But it is important to think about what's the cost of doing so, what's the interest rate, what's the cost of refinancing, how likely am I going to want to hold this for 2, 3, 4, 5, 10, 20 years? Because if you're going to hold a property for 30 years and you know that your plan is I want to retire with no debt in 30 years, that's different than if you're a professional real estate investor, in which case I would argue every 3 to 7 years, depending on which direction the market's going, you have to be refinancing or selling because you have to tap into that equity. Otherwise, you're sitting on a bunch of equity that's non-productive or debt equity.
And we've both been guilty of thinking in the past on our own investments, not just the stuff we've done together, but separately where you're going, I'm never going to sell this thing.
Yeah.
Only to figure out a few years later, you'll do exactly that.
Yeah, it's hard to predict what your situation is going to be like 3, 4, 5 years in the future. Another thing to keep in mind too, when it comes to the debt pay down and refinancing, is that it's really a product of your return on equity. That's really what matters. How much equity do you have? If your property's gone up in value a tremendous amount and you have a bunch of equity as a result of that, your return on that equity is going to be lower than if you're heavily leveraged. So return on equity is important. We did an entire video on that as well, the difference between return on investment and return on equity. I would highly recommend you check that out. And I don't have anything else to say about loans. Do you?
No.
Well, there you go. So we highly recommend you finance your properties, but we also think that it's very important that you spend the time to figure out the terms and make sure you don't get stuck with a loan that you don't want.
That's right. And if you have any questions about it, feel free to reach out to us.
Yes.
Via Facebook, Instagram, etc.
Or you can go to oldfashionedrealestate.com. And as always, don't forget to get your cost segregations done.
That's right. Oldfashionedtaxsavings.com. Cheers.